Chapter 9, Considering Materiality and Risk. The learning objectives are: apply the concept of materiality to the audit, make a preliminary judgment about what amounts to consider material, determine performance materiality during planning, use materiality to evaluate audit findings, and define risk in auditing. Describe the audit risk model and its components. Consider the impact of engagement risk on acceptable audit risk. Consider the impact of several factors on the assessment of inherent risk. Discuss the relationship of risks to audit evidence, and discuss how materiality and risk are related and integrated into the audit process. Firstly, we will address how to apply the concept of materiality to the audit. Materiality is the major consideration in determining the appropriate audit report. It is referenced in auditor's responsibility section of the audit reports, but we need to know what is meant by the term material. The auditor's responsibility is to determine whether financial statements are materially misstated, and the auditor will bring material misstatements to the client's attention so corrections can be made. There are 5 steps in applying materiality. Step number 1: set materiality for the financial statement as a whole. Step number 2: determine performance materiality. And the first 2 steps is represented by planning extent of tests. Continuing our steps, step number 3: estimate total misstatement in segment. Step number 4: estimate the combined misstatement. Step number 5: compare combined estimate, which is step number 4, with preliminary or revised judgment about materiality, which is step number 1. Note that we can revise our judgment about materiality, and we discussed these points in our lecture in details. Step number 3 and 4 and 5, we are considering evaluating results. The second point is about how to make a preliminary judgment about what amounts to consider material. Auditors set materiality thresholds early in the engagement. Thresholds represent the maximum amount that statements could be misstated and still not affect users' decisions. There are several factors affecting judgment, and we need to know that materiality is a relative rather than an absolute concept. Benchmarks are needed for evaluating materiality, and there are qualitative factors that also affect materiality. Such qualitative factors are considerations that may render material a quantitatively small misstatement, which include loan covenant, changing trend, management compensation, financial statement users, conceals an illegal act. It is important to note that accounting and auditing standards don't provide specific materiality guidelines, and the auditor usually uses his professional judgment to set and apply materiality guidelines. The second step in this third point is to determine performance materiality during planning. Which is known as allocated materiality. It is to allocate preliminary judgment about materiality to segments or to each account. Evidence is accumulated by segments rather than for the financial statement as a whole, and most practitioners allocate materiality to balance sheet accounts. The fourth point is to identify how to use materiality to evaluate audit findings. There are two types of misstatements, known and likely. The auditor can determine the misstatement amount in an account, which is the known component of the misstatements. However, two types of likely misstatements, including judgmental differences among auditors and projections of misstatements from audit samples. We just need to focus on our examples that are addressed in our lectures. The fifth point is to define risk in auditing. Risk means that auditors can accept some level of risk in performing the audit. Risks exist are difficult to measure and require careful thought in response. Proper risk response is critical to achieving a high quality audit. The auditors need to understand the client's business and assess business risk. And the audit risk model helps to identify the potential and likelihood of misstatements. The audit risk model for planning the equation is represented as follows. The planned detection risk equal acceptable audit risk over inherent risk times control risk. And this equation will be explained in details next lectures, but we have to know the component of each part of this equation. This figure identifies the audit risk model and understanding the client's business and industry. And after understand the client's business and industry, we should assess client business risk, then assess the risk of material misstatements, which include inherent risk and control risk. The audit risk model, as shown here, planned detection risk equal acceptable audit risk over inherent risk times control risk, and the multiplication of inherent risk and control risk is considered the risk of material misstatements. Here we are showing a difference evidence among cycles. We have 5 cycles, which are sales and collection cycle, acquisition and payment cycle, payroll and personnel cycle, inventory and warehousing cycle, capital acquisition and repayment cycle. When the inherent risk and the control risk are medium for sales and collection cycle, then dividing a low acceptable audit risk over medium inherent risk and control risk will result in a medium planned detection risk. For acquisition and payment cycle, inherent risk is high, control risk is low, and multiplying high inherent risk by low control risk will result in a medium risk of material misstatements. Then dividing a low acceptable audit risk over medium risk of material misstatement will result in a medium planned deduction risk. For payroll and personnel cycle, the inherent risk is low and control risk is low, then multiplying inherent risk by control risk will result in low risk of material misstatement. Then dividing acceptable audit risk, low level of acceptable audit risk, over low level of risk material misstatements will result in high planned deduction risk. For inventory and warehousing cycle, the inherent risk is high, the control risk is high, then the risk of material misstatement is high. And according to the audit risk model, when dividing the acceptable audit risk, a low level of acceptable audit risk over a high level of risk of material misstatement will result in a low level of planned deduction risk. Finally, for capital acquisition and repayment cycle, the inherent risk is low, the control risk is medium, and multiplying inherent risk times control risk will result in a medium level of material misstatements. Then dividing a low level of acceptable audit risk over medium risk of material misstatement will result in a medium level of planned deduction risk. Now we will describe the audit risk model and its components. As we know, the audit risk model component includes planned deduction risk, control risk, inherent risk, and acceptable audit risk. In this point, we will consider the impact of engagement risk on acceptable audit risk. What is engagement risk? And what is the impact of engagement risk on acceptable audit risk? Firstly, auditors decide engagement risk and uses that risk to modify acceptable audit risk. Engagement risk closely relates to client business risk. There are many factors affecting acceptable audit risk, such as the degree to which external users rely on the statement, the likelihood that a client will have financial difficulties after the audit report is issued, the auditor's evaluation of management's integrity, this table, we will illustrate the methods practitioners use to assess acceptable audit risk. For the first factor, which is external users' reliance on financial statements, the methods used to assess acceptable audit risk is to examine the financial statements, including footnotes, read minutes of board of directors meetings to determine future plans, examine Form 10K for a publicly held company, discuss financing plans with management. The second factor is the likelihood of financial difficulties, and the methods used to assess acceptable audit risk include analyze the financial statements for financial difficulties using ratios and other analytical procedures, examine historical and projected cash flow statement for the nature of cash inflows and outflows. For management integrity, it is required to follow the procedures discussed in Chapter 8 for client acceptance and continuance. In this point, we will consider the impact of several factors on the assessment of inherent risk. The first factor is the nature of client's business, such as industry practices, non-routine transactions, makeup of the population. Second factor is the audit experience, which are prior audit results, initial versus repeat engagement, and audit judgment required to correctly record balances and transactions. The third factor is culture, which includes related parts, factors related to fraudulent financial reporting, and factors related to misappropriation of assets. And per se, fraudulent financial reporting and misappropriation of assets are types of fraud. In this point, we will discuss the relationship of risks and audit evidence. All these factors will influence the audit evidence. We should note that inherent risk and control risk have a direct relationship with planned audit evidence. However, planned detection risk and acceptable audit risk have an inverse relationship with planned audit risk. And the acceptable audit risk have a direct relationship with planned detection risk. Auditors can change the audit to respond to risk. The engagement may require more experienced staff, and the engagement will be reviewed more carefully than usual. Here we stress that both control risk and inherent risk are typically set for each cycle, each account, and often each audit objective, not for the overall audit. This table illustrates the relationships of risk to evidence. And we note that there is an inverse relationship between the planned detection risk and the amount of evidence required. As long as there is a high level of planned detection risk, there is a low amount of evidence required. For medium planned detection risk, there is a medium amount of evidence required. Nonetheless, with low planned detection risk, a high amount of evidence is required. However, one major limitation in the audit risk model is the difficulty of measuring the component of the model. The preliminary assessed level of risk is known, but the actual level of risk achieved on the audit is unknown. It depends on the auditor's work and whether he will detect misstatements or not. We will discuss how materiality and risk are related and integrated into the audit process. And this is the last point. The acceptable audit risk and the inherent risk has a direct relationship with planned detection risk with acceptable audit risk has a direct relationship with planned detection risk and the inverse relationship with planned audit evidence. The inherent risk has an inverse relationship with planned detection risk and direct relationship with planned audit evidence. Control risk has an inverse relationship with planned detection risk and a direct relationship with planned audit evidence. And the planned detection risk has an inverse relationship with planned audit evidence. The auditor must revise the original assessment of the appropriate risk, and the auditor should consider the effect of the revision on evidence requirements without the use of the audit risk model. Next lecture, we will applying the audit risk model to finalize the audit planning then we will continue to cover the audit evidence. Thank you.